Good afternoon, everyone. This is the County Employee Retirement Systems Finance Committee regular meeting. So let's start with the legal public statement. Eric?
Sure. This is a regular meeting of the County Employees Retirement System Board of Trustees Finance Committee. This meeting is being broadcast via video teleconference pursuant to KRS 61-826 and may be viewed by the public at the Kentucky Public Pensions Authority offices located at 1260 Louisville Road in Frankfort, Kentucky. It is also being broadcast live via Facebook. If you are speaking and not appearing by video, please identify yourself before talking. If the video or audio broadcast is interrupted, we will attempt to reestablish a connection. If a connection cannot be reestablished within 30 minutes, the meeting will be adjourned and rescheduled to a later date.
Thank you. Next is roll call. Ms. Rankin?
Yes, sir. Mr. O'Meara?
Here.
Mr. Cheatham?
Here.
Mr. Fulkerson?
Here.
And Ms. Pendergrass?
Here.
Oh, and Mr. Powell? Thank you.
And do we have any public comment today?
No, sir, no public comment today.
Thank you. Next is the approval of minutes of the May 29th, 2024 meeting. Do we have move to approve?
So moved.
Second.
Moved in second. Any discussion? Hearing none. All in favor, please say aye.
Aye.
Anyone else?
Aye.
All right. All opposed say no. That approves. Next, we have the financial reports. Mr. Lamb, will you walk us through those?
Sure thing. We're going to start on page 5. I want to first discuss the presentation of the quarterly reports. With our decision to have 2 separate ACFRs, one for the CERS system and one for the KRS systems, we've transitioned the presentation of the quarterly financial statements into how we're going to present each individual ACFR. So what you see before you is the combining statement of fiduciary net position of both the pension plans and the insurance plans, all in one statement with a CERS total. Our external auditor will be giving an opinion on the CERS total. In the prior years, their audit opinion was on the KPPA total. But with 2 ACFRs, we'll have a CERS total that'll be opined upon, as well as a KRS system total. We will also no longer be producing a KPPA combined financial statement. All we will see is the CERS statements and separate KRS statements. So any questions about that, let me know. This is still a work in progress for us, so if you see some things that look a little out of whack or could use some revisiting, please don't hesitate to provide us some comments as we work through this. The one thing you will not see in the ACFR that you see in the quarterly statements is this 2023 comparative year. So for the first year of the ACFR by itself, we don't have a comparative audited 2003 year. So we will just present 2024. We hope to do comparative years in the subsequent financial statements. And of course, you won't see any of these percentages or notes on the right-hand side of the financial statements in the ACFR. So with that, I will start at the bottom of page 5, and you can see that our fiduciary net position for the entire CERS system is $18.472 billion, which is up 10.35% or $1.7 billion year over year. I've also wanted to talk about the 2 pension plans themselves, this $9.7 billion and this $3.4 billion. That's a total of $13.1 billion. That's increased 11.15% or $1.3 billion. And then the 2 insurance plans, the 3.5 and 1.7, That's 5.3 billion total, and that's increased 8.41% or $412 million year over year. There are various notes documenting the changes above 10%. For example, in note 1, it shows the results of the cash management branch evaluating bank account balances and reducing them as appropriate to keep as many funds in the custodial bank as possible. Note 2 elaborates on the decrease in the accounts receivable balance. If you recall, last year we had one large employer who was late reporting and paying contributions, and so that amount due was accounted for in the accounts receivable. So that's why it's gone down quite a bit this year. The investments at fair value in total have increased by 11.56% or $1.8 billion. The two pension plans are up 12.52% by themselves, and the insurance plans are up 9.93%. The largest increase is with the public equities asset class, which is up 15.15%, $1.3 billion across all plans. I'm going to move down to the combining statement now, which is 2 pages away, I think on page 8. Starting there on page 7. Let's jump down to the bottom of page 8 if you don't mind. So here, one more, I think. Yeah, one more page, sorry. Yeah, so this line right above this blue line where it says net increase, decrease in fiduciary net position. So that 1.732 billion is the carry forward from the prior statement. And that's a 10.35% increase, as we talked about earlier. And the increase in fiduciary net position is reflected in the middle right there. So that 1.7. And that last year was 1.455 billion. And so this year that's 19% higher, as well as $277 million higher. The two pension plans, the 936 and the 384, that's a total of 1.3 billion, and that's 282 million or 27.2% higher than the prior year's amount. For the two insurance plans, so you have 296 million plus 115 million for a total of 412 million. That is actually 5.7 million or 1.3% lower than the prior year amount for the two insurance plans combined. That decrease is a result of $114 million. If we go to page 7, show that 114. So it's in this contributions. So this 41, these total contributions of 41.5 million for the C non-hazardous and the 29.1 million for the C hazardous. If you combine those two numbers, that's $70 million. And the prior year amount was $185 million. So that decrease in net fiduciary position is the result of contributions. Also being offset by the $109 million increase in investment income for those two plans. So the investment income for these two plans of 380 and 183, that equals 563 million, and the prior year was only 454 million. So that increase offset by the decrease in the contributions is driving that that negative change in the net fiduciary position. So a lot of this can be elaborated on or analyzed better in the contributions reports. So let's move to page 9.
I believe Betty has a question.
I'm sorry, go ahead, Betty.
The tier 2 employees, members, contribute 1% toward health insurance. I assume that's continuing even though we are not assessing an employer contribution while we spend down the overfunded status. How do we account for that 1% contribution from tier 2 members?
And I think it's also tier 3 members. So I think that is in this health insurance HB1 line item. That's where that 1% is accounted for.
Okay, thank you so much.
Yeah, Betty, I actually had the same question to my people. I'm like, wait a minute, I'm putting in 1% of my salary. Why do I not see a member contribution on the case statements? But it's the same thing. It's in that line item right there.
Yeah, I'm not sure why we call it HB1 instead of calling it member contributions. It might be more comparable.
Yeah, that's definitely something we can look at.
Just a thought.
Yep.
If you and I both had the same question, it might be confusing somebody else.
Thank you for that. Any other questions on those statements before we talk about contribution reports? Okay, back down to page 9. So these reports are very similar to how they were presented last year. The color scheme's a little different. But basically we show the member contributions as well as investment income, and then the outflows and unrealized and realized gains. And so for both pension plans, the member and employer contributions are up. There is more salary and more active members. I do have a count of the member count from 6/30/24 as well as 6/30/23. And for CERS alone, it's up 6%, or 5,992 members. And for the hazardous plan, it's up 1.77%, or 208 members, 8 members. The salaries for the CERS plan are up 251 million, or 8.44%, and for the hazardous plan up 51 million, or 7.21%. So that's accounting for the increase in both the member and the employer contributions. Also, the net investment income is up for both of those pension plans. The benefit payments and refunds are also higher, as well as the admin costs, just slightly. Both realized and unrealized gains are higher for both pension plans. So we get down to that bottom chart that shows the cash flow, and if we remove the net investment income of 217.4 million and 77.9 million for the hazardous plan, then the two pension plans paid out more benefits or refunds and admin expenses than they received in employer and employee contributions by $66.4 million and $96.3 million in the 2023 year, and then 24, the hazardous plan brought in more by 28.4 million. And then we calculate that yield as a percentage of net assets. I think the last quarter this said this yield as a percentage of assets. We've changed that to net assets because we take that that net investment income of 217.4 and we divide it by this end of period change in net position to get the percentage yield of net assets. The insurance plans, the employer contributions are way down for both plans, and that's due to the funded status of those. The Humana Games share was a little bit larger in 2024 than it was in 2023. And we had retired, reemployed, which was larger, and the health insurance contribution, we have more employees, and so that's also larger. Essentially, the investment income is what is keeping these plans funded. And if you look at the cash flow for these as well, you see that for the non-hazardous insurance plan, it's minus 84.1 million and minus 67.6 million for the hazardous system. Any question on those statements, the presentation of them? Anything else you'd like to discuss about them before we go to the others?
I love these reports. They're one of my favorites. It might be interesting to add a schedule that tracks our membership, both by tier and by classification, active, retired, so forth. That's just a thought to throw out there on the table. I don't know whether it belongs in the finance committee or somewhere else, but our membership totals are do create some sort of an impact on our financial numbers. So this might be a good place to monitor that. I don't know how much it changes on a quarterly basis, but.
Yeah, I think, we're tracking it now to help us answer some questions on a quarterly basis. We're kind of using the average member count at the end of each quarter. So Betty, let us put our heads together and present something and see if it helps. Okay, I have a couple of statements out of order, so I think the next ones are the admin expenses, so we'll talk about them first. So this is the admin expenses for the whole fiscal year. And for that first line item, which says personnel, that's really staffing. We spent $35 million, which is about $532,000 above the budget for that line item. It was $2 million, or 6.2% higher than the prior year's amount. This was due to increased staffing, lower than expected turnover, and salary adjustments in various employee categories. For the legal contracts, we were slightly under budget by $17,000 and spent 18.39% or $188,000 more than the prior year. Within this category, we overspent in the hearing officer line item by $106,000. I gave you warning of that last quarter. That was due to increased pay rate and efforts to clear our backlog of cases. We have hired 2 in-house hearing officers as a strategic measure to improve this process for our members. We've also increased that budget line item for next year as well. All other personnel categories were under budget, bringing the total personnel category to $38.6 million or so. This is 6.79% higher, or $2.5 million higher than the prior year, and driven by the staffing and legal categories. The operations total is $5.5 million, and that's $1.2 million below budget for the fiscal year. This is still 14.5% or $700,000 higher than the prior year's amount. Within this category, we were over budget by $173,000 in postage. That was due to the paperless project postcard, as well as an overall increase in postage rates. We were under budget in other categories such as travel and IT costs. Let me jump down to the bottom of the next 3 pages. I think it's going to be, yes, go up one more, Sherry, sorry. And let's go to the bottom of this page. Yep. So this subtotal line item prior to reserve, the total expense was $44.1 million. Overall, we were $1.4 million below budget, meaning that we did not need to spend any of this $4.8 million reserve. So overall, the admin costs for this fiscal year were 7.71% higher than the prior year, or $3.1 million, but we're below our budget overall. This hybrid percentage is the initial breakdown of these admin costs to the 5 pension plans. The chart right below that is the final allocation. If you page down just a little bit, Sherry, we had to take into consideration specific plan costs as well as separation costs. This is the last year of separation costs. So after making all of those adjustments at 6:30 for our financial statements, those are how that $44.1 million was allocated among the 5 pension plans for fiscal year 2024. Any
Mike?
questions on the admin costs? Yeah.
I just want to make an observation. It's been made before, but I just wanted to give it some more time. You said that we had higher personnel expenses and that we were over that personnel budget. But I wanted to remind everybody that the personnel cabinet has position control in place. We were not over or did not hire people that we were not supposed to. And that the fact that we spent more on that line item was not over our total budget or our personnel budget. So, I mean, what was the term you used?
Staffing total, yeah.
Total staffing. So there'd been some questions in the past about that. I just wanted to make that clarification.
Yeah, thank you. Sherry, if you go to page 11, you can see the individual line items in that staffing category, and it'll show you where we were over budget. So that remaining column shows that 577 in salaries and wages, but we were also under budget in other categories such as sick leave, and then this staffing totals 535. But the whole personnel category is this whole first page, including legal costs, et cetera, et cetera. So we did not expend our budget there. And being that we're restricted funds, we have a lot of latitude in how we allocate the budget that's been given to us in the House bills. So we can allocate that among these line items as we see fit, because they are restricted funds. But yes, Mr. O'Meara is correct. We do not go over our head count. cap. So none of those costs were because we went over headcount or anything like that. We just had some, we just didn't allocate enough to that specific line item when we took the full allocation.
That was all. I just wanted to make that comment.
Appreciate that. I think if we go back to page 13, the next set of charts are the Chase charts. These were the fees that were being charged to us, and the first 3 months were prior to us converting all of our accounts to hard dollar interest. So as you can see, we average about $7,000 or $8,000 a month in fees. We had a couple larger months there, and that was because Chase was printing checks for us because the finance cabinet's check printing machine was down. And so we get charged like, 3 cents per check or something like that. So it was a little bit higher in those months. The chart right below that shows the hard dollar interest that we were earned in the various Chase accounts that we have. So quite a bit of money was earned in hard dollar interest over the fiscal year. And then if we go to the next chart, we now have the invoice reports for the C systems. So I'm sorry that those were out of order. That was my fault. But the 6/30/24 amount is $3.4 million. That's 7% lower than the amount at 3/31/2024 of 3.
Question before we get too far into the invoices.
Yeah.
Just from your perspective on the financial statements, did you see anything unusual in our fiscal year 2024 operations that caught your attention?
I have not seen anything that really caught my attention at this point, but not done looking. So let me caveat that with, I'm not done looking.
Very good.
Mike,
Yes, sir.
might be a question a little bit out of place. The hearing officer issue has been an ongoing not over budgeted, over expended area for the past few years. Do we, last I heard anybody tell me, we were in the process of hiring more hearing officers, bringing it internally in order to deal with this backlog. Do we have any idea whether that backlog has been cleared up? To what extent, that turns into an over-employed area later on down the road? Or what?
So my understanding in working with the budget group on this, that we do have the 2 hearing officers in place, and we're going to maintain, I think, 3 contractors as well. So if and when, let's just say when the backlog is caught up, we have the ability then to roll off the contractors and keep the 2 employees to manage the workload of the hearings. We still need the contractors because of the backlog. I don't know for sure, but my understanding is we haven't made a lot of progress yet on the backlog. I think the 2 hearing officers are fairly new, still getting their feet on the ground, etc. But the intent is to utilize contractors and employees to manage that backlog.
You're
As
correct.
a member of DAC, I can tell you that we're still looking at old cases in the DAC and ACT committees. And I'm not convinced that it's a shortage of hearing officers as much as it is a function of how this process works. It just takes time to go through all the steps in these reviews. I mean, there are multiple opportunities for members to have plenty of time to respond. You have the normal court types of responses for both councils on both sides. So when you have all of those steps in a process that is very much like a case going through court, I think we will always be dealing with a bit of a backlog.
Mr. Cheatham, I will say that the hearing officers report to me, and I am working with them to get some data behind how well is this working, what's the backlog, how quickly are we moving through all of that. We're really just at the beginning. They've each have a handful of cases. The backlog exceeds 100. So I would say we're looking at least a year process before we can see a huge dent in anything. But I'm with you, Betty. We need to look at a plethora of data and really examine where we are and what's working and what's not working for us. So all that's coming, but we're really just at the beginning of that. We got these folks in place in, I want to say June. So it's just been a couple of months. They're still getting their feet under them.
In the DAC committee, we have been making suggestions on areas that might be open for, or areas that could be changed in the statutes that would reduce the workload overall. I mean, we review disability provisions for members who have diseases or disabilities that can never be resolved, but we still look at them every 5 years. So we've been making some suggestions on potential legislative changes that might help with reducing the number of cases that we have in total. So there might be more opportunity for looking at how we manage disability cases and reviews in that area.
Are some of these cases being reviewed supposedly every 2 to 3 years?
Yes.
It seems like that might be an area of overkill that may be causing a bit of a bottleneck.
Yeah, I think it would require some additional information from our medical reviewers to have some kind of assessment of a member's individual situation. Is this something that can be resolved with surgery or medication? Is this something that can never be resolved? So I think those assessments might be a way to relook at the timeline on how we go through these cases. It, I think we have too many cases to start. And if there's a way to reduce that caseload before it overwhelms staff and our medical reviewers and our hearing officers, it might be worth a look at the legislation.
Sorry, I know that was a little bit off subject, but I had not heard any updates lately. Thank you.
Thank you for those questions. Very helpful. Back to this invoice report. This is the outstanding invoices, and we do this every quarter. So the 630 amount's almost 3.4 million. It's down from the 3.6 million amount at March, 7% increase. The top 10 employers are pretty much the same. If you notice, the top 5 all have little stars by them, which mean that legal is aware of them and is working on those past due invoices. The Kentucky River Jail is omitted employer. Covington's pension spiking and reinstatement. Kenton County Airport's pension spiking. Fort Thomas's pension spiking. And Livingston Fiscal Court is about 2/3 of their costs are monthly reporting past due, and one is health insurance reimbursement, the other third of that. So that's the unpaid balances. They haven't changed much from quarter to quarter.
Two pretty significant increases, Mike, for two that don't appear to be tied up in any kind of legal action. Was it the Audubon Area Community Services, City of Winchester? Do you have any idea why that is?
I can tell you in just a second, I think. So the City of Winchester's monthly reporting, it looks like they're about $45,000 a month, and they appear to be behind just a couple months there. So that's probably what's the increase for them. I don't know if it's a new reporting official or any other issues. If DeJuan's aware of Winchester, he could step in, but that's the invoices that are outstanding or monthly reporting.
This is Dewan. One of my employees has been working with City of Winchester. They were kind of behind on some of their reporting and some of the invoices, but they're currently being worked on, so that should drastically decrease by the next report come around. I will have to check on Audubon, though. I'm not sure of why that increased. That's something I will check into, though.
Any other questions? I think that's the end of my list today. Oh, sorry. These are the penalty invoices by month. And we had 5 that were waived for a total of $5,000, 12 that were created for a total of $12,000, 32 that were paid, totaling $32,000 for the quarter. And now I think I'm at the end.
Thank you, Mike. Next is hazardous duty request. Mr. Surratt, would you want to take those and explain it to us, please?
Yes, I can. Good afternoon. Today we have 16 positions being requested for hazardous duty coverage. All 16 of these positions are either police or fire positions. So we have reviewed the position questionnaires and the job descriptions for all these positions, and they do meet the statutory guidelines for hazardous duty. Therefore, we do request the CRS Finance Committee to approve these to go forth in front of the CRS Board of Trustees for final approval. If anyone has any questions about any of the positions, please let me know.
I move for approval of these 16 positions in accordance with their applications.
Second.
All right, I have a first and a second. Any other discussion? Hearing none, all in favor, please say aye.
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 Opposed, no. That's approved. Thank you. So let's see what's next on our list. Investment trust budget. Mr. Willer.
Thank you. Good afternoon. Sherry, if you could move forward one page, please. We ended the fiscal year well below budget, having spent only 71% of the amount budgeted for the entire fiscal year. The consulting and contractual service categories, as we can see, were in line with the amounts budgeted, while legal and auditing services came in well below what was budgeted for the fiscal year, with only 45% of the amount budgeted spent. I would also note the significant variance at the individual service provider level, as noted in that percentage of amount budgeted column. As we know, these expenses can be difficult to predict and are often driven by activity outside of KPPA's control. In the orange column on the end, I've also included the approved investment budget for fiscal 2025. Overall, the budget was increased 2.3 million or 23%. And while most of the categories and the individual line items were only modestly increased based on expected contractual inflation adjustments, the amount budgeted for legal services was increased by 1.9 million or 38%. And that was based on discussions with the legal group on their anticipated increase in costs associated with ongoing litigation, as well as the trustee and officer litigation insurance policy being exhausted. We've also budgeted, I would note, one additional private markets consultant, and this would be to complement our existing services as we look to rebalance the portfolios consistent with the revised IPS asset allocation ranges. I'll pause there for any questions on the budget itself. Seeing none, we can move forward. I think, Sherry, page 21, please. That page right there, perfect. As the table highlights there, for the full fiscal year, investment fees and expenses were 34.7 million more than in fiscal 2023, but 28 million less than in 2022 and in line with 2021. As the table highlights, there's significant volatility as to the composition of the total fees and expenses, and that's across time, with the largest drivers being the performance fees and the miscellaneous fees and expenses categories. If I would focus just in on the investment advisory fees, which are really the base fees that the systems pay to external investment managers, I would note that they're pretty consistent across time. And with only a 13% increase in fees since 2021, despite a 20% increase in total assets over the same period. This is driven by the composition of the asset allocation, as well as the successful fee negotiations staff has accomplished with individual investment managers. Our base fees are low even by institutional standards for the size of our assets. Core fixed income is less than 7 basis points. Public equity is around 16 basis points. Specialty credit around 50 basis points. Real estate 77, and private equity 47. Excuse me. That varies. Obviously, it's a point in time measure, and it'll vary based on the composition of the underlying mandates within each of those asset allocations. But those numbers were as of the end of the fiscal year. And again, those are in line, if not lower, than other institutional clients with similar asset size. We continue to see significant volatility in performance-based fees across asset classes, and that's especially evident in the alternative asset classes, which tend to be more heavily skewed with a variable component to their fees. For fiscal 2024, specialty credit performance fees were up $17 million. And that's as the portfolio produced a return of 12%, which was 500 basis points better than in 2023 and 10.5% better than in 2022. So as performance has gone up, we participate. That's a sharing agreement. We typically, even in the old 80-20 rule, we would take 80% of the upside. The manager gets 20. Most of ours are less aggressive than 80-20, but as performance has gone up, those performance fees you'll see those performance fees goes up. Private equity performance fees also increased as the portfolio produced a 3.8% return, rebounding from a negative performance in 2023. Alternatively, as we can see, performance fees for real estate have continued to decline as the portfolio produced a negative 9.9% for the fiscal year, following a negative 2.7% in 2023. We've also seen a sharp rise in that miscellaneous expense category, and that's for strategies that employ some type of credit facility in their management, and that's consistent with the rise we've seen in the short-term rates from our zero interest rate of the ZIRP world. Specialty credits saw an increase of $12 million, and real estate saw an increase of $3 million. And I would note that these credit facilities are a key element of the investment strategies, where the portfolios earn an additional spread above the base rates, whether it was historically LIBOR or currently SOFR, in addition to that cost of those credit facilities. So despite the cost of the facilities increasing as rates have risen from zero bounds, the portfolios have benefited by earning more on the investments that those credit facilities are used to fund. I would also highlight the reduction in core fixed income advisory fees. For the fiscal year, it was a reduction of $350,000 from the prior fiscal year, and that's despite a 25% increase in the market value. That was driven by rebalancing the portfolio, including bringing that sleeve of the portfolio in-house, which ultimately, as we've discussed, we expect to reduce fees annually by $1.5 to $2 million for core fixed income. I'll pause there for any questions.
These reports are very, very helpful. When I went today to look at the website, I noticed that these particular reports are not in the investment library. Would it be possible to add these to the library? I think they are very informative.
Sure. I think we do include them in all of these reports are included in the IC material, but we can have a separate category for putting them on the website.
I didn't look under the IC material, but yeah, it might make it easier for somebody other than trustees to find them.
Sure. I'll make a note of that.
Steve?
Yes.
I went through and tried to do a bit of a comparison between the screen I think you've got up now. I've got to switch back and forth. Hold on a second. Yeah. What you got up there now is all of the pension funds.
Correct. It's at the trust level.
Correct.
Yes. That's the trust level. Correct.
Okay. I went back and tried to do a comparison between the costs, and when I looked at cost, I didn't look at them on the individual level as far as the advisory fee versus performance fee versus miscellaneous. I just looked at the total. Can you go back and I want to make sure I heard you correctly under specialty credit? What did you calculate your expenses there are?
So on the investment advisory fees, which was what I was quoting, is simply 50 basis points. So that would be our base fee.
Okay.
And
Like I said, I looked at the total. I
Mhm.
just want to make sure our terminology was the same, but I looked at the total, and that number came in at a little over 2.5%.
Yes, about 50 basis points of that is base fee. About 1% is performance fees, and this is in the last fiscal year. And then that miscellaneous fees, which is the credit facilities, is about 110-ish. That
The two things that I guess I have a question about. One is just what is it, and then the other is it something that we could add to the report? Because I found it really helpful when I took those numbers for the KPPA system and compared them up to the exact same numbers for the CERS system. And there's some differences, and I'd really like in the future to be able to see that report and see that comparison on a percentage basis and an explanation as to why there's a significant difference between the fees, overall cost paid per asset class between KPPA, and I'm sure part of it has to do with asset allocation versus one system versus the other. But there were some differences. And then the last line on the report was, you've got administrative expense / cash. Is there, and this may be more of a question for Mike, I don't know, as to a breakdown of what exactly that is. Because that, that came out to be, better than a 1% cost on cash, or whatever makes that number up.
I think Ann's got her hand raised, and she can probably add better color there than I can.
Yes. So administrative expense cash. So ultimately the market value that's represented there is what's in our cash account. The expenses are the administrative expenses, which is basically what we just went through with his investment budget. So that's what falls under that line item.
Okay. Well, and I'll just put it from a macro level. What I looked at was, and it includes miscellaneous, it includes advisory fee, it includes performance fee. Total expense for KPPA overall was just over or just under 76 basis points. That number for the CERS system was 83.4 basis points. That's a difference on a cost basis versus assets of about $9 million from a cost standpoint. I just would like to understand why and where that's coming from.
Would that be because the administrative expenses get split on that same percentage that we use for other admin costs? No, and shake her head. Okay, that was just a guess on my part.
Sorry, they're based on the we take the last day of each of the prior month, and we use the market value of each asset of each plan for those.
And from an investment perspective, the investment advisory fee, performance fees, those are pro rata allocation. The difference between the composition of the overall fees is going to be based on the difference in the asset allocation. And that can be the asset allocation at an asset level, as well as individual mandate levels. As we know, we don't do, those tend to get allocated at point in time. For instance, there's if we look at the most obvious is the private equity portfolio, where we saw a number of plans that didn't invest. So while at the trust level, we're reporting the overall investment advisory fees, the participation in each one of those underlying portfolios or mandates is pretty different.
Yeah, and that kind of goes to why I'd like to see a little bit of a comparison between the CERS and KPPA as a whole, so we can see where those differences actually break
Sure,
out on an asset allocation basis.
Happy. I think that's probably, if we want to incorporate that, I know we have a discussion slated at some point for the review of the reporting that we bring to the IC and the board and to this committee as well. Happy to roll that discussion in as well and see what we might be able to present that would meet that need.
Okay. Thank you.
You're welcome. That's all I had, unless there were any additional questions.
Anything else for Steve? All right, thank you, Steve.
Thank you.
And that actually is the end of our agenda. This being a regular meeting, are there any other items that we wish to discuss? Going once? All right, hearing none, we'll declare the meeting adjourned. Thanks for everybody's time. Appreciate the valuable information. Thank you.
Thanks, Bill.